Hi, I'm Christine Short, Director with S&P Capital IQ Global Markets Intelligence. In this week's Lookout Report, we provide a halftime update for first quarter earnings season. After a rough start to the first quarter earnings season, estimates have finally turned positive. With 71% of S&P 500 companies having reported, analysts now expect growth of 2.2%. Consensus expectations bottomed out at negative 1.2% on April 11th, right after receiving dismal results from JP Morgan. Generally speaking, it has been financial sector companies that have weighed down S&P 500 earnings growth. In fact, profit growth excluding the financials turns out to be much healthier at 4.9%. After 7 consecutive quarters of record earnings per share figures, it looks like that trend will end in the first quarter, with analysts expecting EPS to come in at $27.28, about $1.18 shy of last quarter's record. At the beginning of the season, Global Markets Intelligence predicted that the first quarter growth would settle somewhere around the 3% mark, based on the historical trend in which expectations at the beginning of any given earnings season rise by 3.9% by the time all companies have reported. With 67% of companies beating analyst estimates at this point, we're well on our way towards that 3%. So far, companies having reported first quarter results have beaten estimates by 5%, and if companies maintain this pace over the second half of earnings season, final growth would end just north of 3%. Even if we do end at 3%, it would still mark the weakest quarter for S&P 500 profit growth since the third quarter of 2012. The defensive sectors continue to lead first quarter growth, with telecommunications services and utilities sectors expecting the highest growth rates of 43% and 21% respectively. On the flip side, the financials and energy sectors continue to lag. Very broadly, some similar themes have emerged amongst first quarter press releases. The most commonly cited reasons for weakness have been poor weather during the quarter, unfavorable foreign exchange rates, and weakness in mortgage originations and applications. Alternatively, some reasons for strength have been positive retail figures, the continued health of the U.S. consumer, and robust sales in China. Revenues will continue to be in focus for the first quarter as a true measure of corporate health. Currently, analysts anticipate top-line growth to come in at 3.5%. This is the first time since the second quarter of 2012 that analysts expect sales growth to outpace bottom-line results. Despite the upward trend, this is still a persistently low number, which shows that corporations are continuing to streamline and cost-cut their way to growth each quarter. Expectations for the second half of the year are slightly better at 4% for the third and fourth quarters. Looking ahead, 77 companies are scheduled to release results next week, at which point over 90% of the index will have reported. I'm Christine Short, and thank you for tuning in to this week's edition of the Lookout Report.